traditionally, wealthy people have liked to maintain 10% of their portfolio in gold, and they don't have it there because they think the price of gold might go from 2,000 to 2,270 or 2,300. They have it because they're afraid that the price of gold is going to go to $8,000 or $10,000. They're afraid that the rest of their portfolio is going to get massacred. And so they own the gold as sort of a counter-cyclical hedge against the rest of their portfolio. And I think that's a highly intelligent way to own it. And I think that's precisely the way that Dalio owns it.
So it doesn't sound like you think at this point the trade is too crowded. It sounds to me like you think there's plenty of room for growth, especially on the institutional side.
Well, I do want to say, once again, I mean, the answer to your question directly is yes. But I want to say on behalf of speculators who might be listening, the easy money has been made. That's over. Yeah, taking the stuff from $20 a pound where it has to go up to $100 a pound where it doesn't have to go up, and taking a basket of juniors up 300% because people don't hate them anymore means that the easy contrarian money is off the table. It's in the genes.
It's a fair point. So more than 50%, from my understanding, from my reading, of U.S. uranium needs is still met by Russian imports. And there are bills right now before Congress to ban Russian uranium. And so obviously something to consider would be Russia's retaliation in terms of immediately cutting off supply to the U.S. if our Congress did pass a bill and our president did sign the bill into law. Even if Congress put some future date on it, in your analysis, what's the likelihood of a bill getting signed into law banning Russian uranium anytime soon, considering the strain and the issues it would cause in the states at this time?
The probability of the House and the Senate doing something stupid is 100%. Whether or not they'll do that is a different question. But it doesn't matter. This is all a sideshow. It's all politics. Uranium is fungible. If we ban Russian exports, the Russians will sell to the Chinese. And the material that the Chinese buy from the Russians, they won't buy from Canada. And Canada will sell it to us. What you're talking about really is this theater with Putin and Biden having a dumb contest and both of them winning. It doesn't impact the market because the stuff is fungible.
Okay, so my next question was going to be how, if that were to take place, how would the U.S. ultimately meet their agenda of tapping enough domestic supply? But it would come from Canada is what it sounds like.
It come from Canada or Australia. It doesn't matter. I mean, the stuff is fungible.
Okay. So here's a question. Does SPUT have any responsibilities or obligations to sell uranium to utilities in the event that the utilities cannot source enough uranium supply on the market themselves? So in order to prevent the need to shut down a reactor, and if they do have a responsibility or obligation, what kind of price above spot would that uranium fetch in that type of situation?
We have no obligation to do that whatsoever. When we were negotiating with the Securities and Exchange Commission and the New York Stock Exchange to list the product on the New York Stock Exchange, we proposed that product, like our gold and silver product, have a class of share that was redeemable to allow utilities to redeem it. We didn't want individuals to be able to redeem it because we didn't want people having barrels of yellow cake in their garage, you know. The SEC and the NYSE thought that two shares of stock, one where a certain class of shareholders would have more advantage than the other class of shareholders, was unfair. And I can see it from their point of view. The product as it exists now has no sale mechanism at all. It's a roach motel. You can get in, but you can't get out. My suspicion is if we saw a real shortage of uranium in the world, where 50 million pounds was decreed by somebody to be strategic, and they decided to pay the Sprott shareholders a 25 or 30% premium to spot, that Sprott would have to consider on behalf of all shareholders, myself included, whether they should declare victory, take that 30% premium, and drive on. My inclination would be to say yes. But at present, there's no sale mechanism. We can do exchange swaps, and we do it. If we're the only entity in the world that I know of that has inventory in all 4 of the major repositories. So if CAMECO has a sales need in France, but they don't have material in France, we can deliver it for them in France and take delivery in Canada. We can do that. We can do swaps, but we can't do outright sales.
Okay. I want to turn to CAMECO. The recent guidance came out. Their average realized price was about $52 per pound, which significantly below spot price.
Yep.
From an improved profitability standpoint, will they miss the run-up that has occurred in the spot price because of their contract structure? Shouldn't they be moving mountains right now to increase capacity in order to better capitalize on the increase in prices instead of losing money buying in the spot market, trying to meet their contractual obligations? Can you speak into that?
Yeah, I think they're playing a game of chicken right now. They were caught with their pants down in terms of cutting production and having existing contracts that didn't roll over. When I say a game of chicken, I think they're leery to restart the shut-in production and change the tightness in the spot market because they anticipate that they will be able to make up for the deficit in the term market going forward. What that means is that they have to rent capacity rather than build that capacity. They're really, truly, I believe, playing a game of chicken.
So in their recent guidance, it was pointed out in the data that for every $5 rise in the price of uranium above $91 a pound, that it cost CAMECO $49 million in negative cash flow.
Correct.
I'm just sitting here wondering, how should investors properly be viewing CAMECO relative to other producers and maybe even explorers considering this information?
They have no peer. Kazatomprom is a better company in terms of resource base, in terms of cost, an equally good company, at least in terms of technology and management, but it's hampered by being in Kazakhstan. It's hampered by internal politics in Kazakhstan. It's hampered by the geopolitical constraints of moving uranium out of Kazakhstan through either Russia or China to world markets. And it's constrained by the fact that the Kazakh society isn't a modern society like ours. I own personally more Kazatomprom than I do CAMECO because I'm reasonably conversant with the risks. And frankly, I've been wrong before. I might be wrong again. I like the cheaper companies. But when you get below those two, there are no reliable suppliers. There's only BHP, which produces uranium as a byproduct out of Olympic Dam. So really, if one is going to be in the uranium space, the names that you come down to are CAMECO, and CAMECO. What you decide is, do you want to buy them now and suffer through what may be a 2-year hiatus of negative cash flow associated with the preponderance of term contracts over production capabilities? Or do you want to buy the annuity that will result from their monetizing 15 years of future production against term markets that have not yet been signed?
Yeah, I appreciate that perspective because there's been a lot of chatter about CAMECO's balance sheet and about these contracts and about comparing them to other producers, and that puts it in a different perspective in light. So I do appreciate that.
It would be very easy for CAMECO to balance any short-term balance sheet issue by doing a commodity-linked bond. I would be a buyer.
So, Rick, before we move on to some additional questions on gold, I want to mention your upcoming Bootcamp and Symposium. The Bootcamp is called the Prospect Generator Bootcamp. It's a jam-packed day of disruptive ideas and groundbreaking insights shared by some of the most revolutionary minds. These are all experts that we're listening to now. Key discussions are going to center around the instruction on investing and speculating. The Bootcamp is a virtual event. Viewers, y'all can enjoy it in the comfort of your home, your favorite coffee shop, or really wherever you like. It's one day only. Tickets are only $99. I'm going to put a link for the viewers to sign up down in the comments in the description below. The boot camp is really a don't miss event. And the second event that needs mention, Rick, is your annual Rule Symposium in Boca Raton, Florida. That's going to be held July 7th through the 11th. It's a natural resource investing focused symposium where the attendees are going to get front row access to exclusive insider insights from living legends such as yourself, Brian Lundeen, Danielle DiMartino Booth, Grant Williams. And I saw the whole slate of speakers. There is some amazing speakers lined up. They're all going to provide critical insights into what's happening in the resource sector right now. So you don't want to miss that. Attendees are also going to get to participate in sponsored breakfasts, lunches, breakout sessions, and panel discussions. And there's going to be mining company sponsors that are present, uranium, gold, silver sponsors. So the attendee, you can interact with them, you can ask questions, you can go deeper into their respective businesses, and ultimately you could determine whether or not you believe they're worthy of an investment from you. So, I mean, that's a great opportunity for you to network. So everybody go look in the description and the comments section where I've posted the links to these two must-attend Rick Rule sponsored events. Do not miss this gold level opportunity to expand your resource investing education and network. Go sign up now. Okay.
Let me add something, Gary.
Yeah, please.
Unlike any other online or in-person seminar that I know of in the world, this comes with a gold-plated money-back guarantee. We've been doing this for long enough, and we're confident enough in the product that if for any reason you attend the boot camp or you go to the symposium, whether you go to the symposium live or live stream. Remember, you don't have to go to Boca Raton. You can watch Boca Raton from your home. But if for any reason you don't think that you got your money's worth, email me. I'll give you your money back. We're confident enough after 30 years of doing this that we absolutely positively have a money back guarantee. There's no other educational sponsor that I know of that has the courage of the conviction around their product to be able to do that. One more time, absolute money back guarantee.
Well, I, for one, am planning on being down in Boca Raton. So any of the viewers who are planning on going, I hope to see you there. Come say hello. All right, Rick, let's get back to a few questions. I'd like to steer our discussion towards gold. What's your current 10,000 foot macro take on the current role and need for gold and what you see happening with the precious metal in 24?
I think the need for gold is unchanged over 1,000 years. The perception of the need for gold changes. Gold does well when people are concerned about the maintenance of their purchasing power in traditional fiat-driven savings instruments. We've lived through probably the 40 most benign years in economic history, the period 1982 to 2002. Inflation was muted. If you were a U.S. dollar saver, the dollar was strong. Equity markets were good. Real estate markets were good. Employment was good. Doesn't get any better than that. So people haven't been afraid. But while they haven't been afraid, pressures have been building. And I'm just talking about U.S. dollar pressures. The other pressures are worse. I laugh that the U.S. currency, as scary as it is the best currency in the world, or the worst currency in the world, pardon me, except for all the others. Right. So we'll talk about dollar problems. The first that I see is quantitative easing. If you did it, Gary, if you printed up a bunch of Garys, that would be called counterfeiting, and you would be put in jail. But if you're a member of Congress and you counterfeit, it's very popular, and you get reelected. Irrespective of its popularity, the creation of more specious currency units with no backing doesn't make the existing currency units more valuable. It makes them less valuable. The second problem is bigger. That's debt and deficits. At the federal level in the United States, we owe $34 trillion on balance sheet. That's with a T. But that's not the worst problem. The worst problem is that the net present value, not the future undiscounted, but the net present value of entitlements, Social Security, Medicare, Medicaid, military pensions, Congress pensions, little things like that, exceeds $120 trillion. So as a society at the federal level, before state and local debts, we're $120 trillion behind the eight ball. 150 trillion behind the eight ball. I lost 30 trillion somehow, like Congress. And we're trying to service this debt with a budget that's in deficit $2 trillion a year. Now, there's two ways out of this. You can renege. You can tell the bondholders and the Social Security guys you aren't getting paid, or you can inflate away the net present value of the obligation. I think door B occurs. And I think that I think this becomes a more visible problem. I remember, unlike many of your viewers, the decade of the 1970s, the last time the gold price really ran. And it ran for the same reasons. It ran because we fought the war in Vietnam and we fought the war on poverty. And by the way, we lost both. What we ended up with was this huge deficit. We either had to renege on our debts or we had to inflate away the value. Although the writing on the wall was there from 1968 to 1973, nobody much paid attention. It took 5 years for the specter of inflation to bite people. And my suspicion is that people aren't afraid enough yet. Gary, as you know, I love statistics. So here's a really interesting one that maybe says it all. The market share of precious metals and precious metals related assets in the United States relative to other classes of saving and investment product is less than 0.5%, which is to say less than 0.5% of all the savings and investment assets in the United States are denominated in precious metals related assets. The 40-year mean market share is 2%. I'm not one of those who says that the dollar's going to collapse and catastrophe is going to end and gold's going to win the war against the US dollar and US treasuries. I'm not saying anything like that. I'm saying that because of quantitative easing and debt and deficits and inflation, real inflation, that the market share of precious metals and precious metals assets will at least revert to mean. Mm-hmm. And if that happens, you will quadruple demand for precious metals and precious metals related assets. And I think that that'll happen over the 5-year time frame. What impact will that have on price? I don't know.
Yeah, so I've got 4 or 5 more gold-related questions, and I know we're getting close to the end of our time. So I'm really hoping we can get these all in here. So, you know, gold has no debt obligations, political obligations, or printing press. The dollar and the euro, 2 of the 3 largest reserve currencies in the world, aside from gold, are weakening versus gold. The mining equity stock prices are low. There's really no gold narrative to speak of in the Western world whatsoever. In your analysis, what's going to be the trigger to get folks in the Western world moving into gold again?
I don't know. I mean, just to be completely honest, I don't know. I suspect a realization that inflation is greater than it is. Most people measure inflation by the CPI, which is a constructed index. It's hedonistically adjusted, whatever that means. It doesn't include food or fuel, which I guess is relevant if you don't drive or eat. And most importantly, it doesn't include tax. A cost of living index, it doesn't include the most important cost component that people face. My informal calculation tells me that my savings in terms of the basket of goods and services that I consume are deteriorating in purchasing power by about 7% per annum. Mm-hmm. What happened in the early part of the decade of the 70s is that people weren't afraid of inflation until they'd had 5 years of being bitten by it. And I suspect that in the next 2 or 3 years, as people face higher taxes, higher prices at the pump, higher new car prices, higher food prices, higher rent prices, that the realization that inflation isn't a subject, but rather is a risk that cuts into your family's standard of living. I saw this happen in the 70s. Inflation went from being a topic of interest to being the primary economic concern in the country. And I suspect that that'll happen in the United States over the next 5 years. Now, with regards to the mining shares, they have to overcome a substantial period of self-generated underperformance. And I think that'll take longer.
So I was going to ask you about the miners. I'm going to ask you this. If you owned gold miners and it was evident that a recession was strongly forming, would you exit miners and wait until the recession did its worst? Or do you see that the economic scenario is being a positive for gold miners, similar to how it was for homestake mining during the Great Depression, where both share price went up by 600% and dividends skyrocketed?
It depends on the scale of the miner. The large, mature miners with access to capital and access to credit, you hold, because the fiscal measures that the government takes to take us out of a recession will be wildly bullish for gold. The smaller companies that lack access to credit can go broke in a recession. Recession diminishes confidence. And that confidence, the diminishment of confidence, is expressed most in marginal assets. And there is no asset in the world as marginal as a junior gold company.
Okay. So you were talking about the amount of gold ownership. Recently, it's been reported that more than 80% of the population owns zero gold. Yet
Right.
last year in an interview, Ray Dalio, founder of the largest hedge fund, he said that we should have a 10 to 15% gold overlay on our portfolio. Why is the overwhelming majority of the population so woefully underinvested in gold? And do you agree with Ray? Do we need a 10 to 15% overlay?
40 years of benign economic climate means that people haven't had to own gold. And people's expectation of the future is set by their experience in the immediate past. I watched the same thing happen in the early part of the decade of the 70s. Really, truly, the writing was on the wall, and really, truly, nobody wanted to read. This is a self-fulfilling problem. Now, people whose portfolio is already inflation hedged, people who own moderately leveraged real estate, where the replacement cost for competing product goes up, don't need to own as much gold. People whose portfolio is largely made up of intermediate and long-term bonds, where they get massacred by inflation, need a larger proportion of gold. So although people want a one-size-fits-all answer, there isn't a one-size-fits-all answer. It depends on your circumstance. Traditionally, wealthy people have liked to maintain 10% of their portfolio in gold, and they don't have it there because they think the price of gold might go from 2,000 to 2,270 or 2,300. They have it because they're afraid that the price of gold is going to go to $8,000 or $10,000. They're afraid that the rest of their portfolio is going to get massacred. And so they own the gold as sort of a counter-cyclical hedge against the rest of their portfolio. And I think that's a highly intelligent way to own it. And I think that's precisely the way that Dalio owns it.
Makes a lot of sense. All right. So before we wrap up here and I ask Rick the final question, I want to point everyone over to our Substack, which is metalsandminers.substack.com. We post a lot of free content on the consumer, economy, markets, and individual metals and miners each and every week, keeping what is important top of mind for you. It's all organized in one digital destination that you can come back to, refer to anytime to put the pieces together. So go subscribe for free, go get access to all of that. And if you want more, we do provide premium content there as well. And there's instructions on that. If you've enjoyed the conversation with Rick as much as I have, please let him know by hitting the like button, clicking on the red subscribe button and the bell icon, and leaving a comment below. I know, Rick, we're really out of time. I just wanted to ask you a final question here. What haven't we spoken about that you want the viewers to know or be aware of for 2024?
It isn't mines or metals, but sometime we should do an interview on oil and gas, which is probably for most investors the best natural resource investment opportunity available over the next 5 years.
Okay. Yeah, I would love to. So I'll have you back as soon as possible for that.
Great.
So yeah, thank you for being so generous with your time, Rick, your analysis, your ideas, and for coming on to the Metals and Miners podcast. It's been amazing to spend this time with you. Rick, would you please tell the viewers where they could learn more about your work, how they can connect with you, and where you could be found?
Well, if you've enjoyed my comments about natural resources and you want to speak about your resources, specifically your natural resource portfolio, go to my website, Rural Investment Media. List your natural resource stocks. Please, by the way, no crypto. Please, no pot stocks. Please, no tech stocks. Natural resource stocks only. I'll rank them, no obligation, no cost. I'll comment on individual issues if I think my comments might have value. Go to the Rural Classroom, where you'll find 200 hours of instructional programming for free. Learn how to be a better analyst yourself so you don't have to listen to me, or at least you can question me intelligently. If you are already a committed natural resource investor, absolutely come to our sector-specific boot camp and come to the Natural Resources Investment Symposium in Boca Raton, either in person or, like 1,500 other people last year, in the comfort of your own home, live streamed online. Rural Investment Media, Rural Classroom, the symposiums. And oh, by the way, look at my chest.
Battle Bank.
If you're not happy with your current bank, and I suspect that means all of you, check out Battle Bank, either at the Rural Investment Media in the question and comment section by saying bank, or at battlebank.com.
Rick, you've been so gracious with your time. Thank you so much for spending it with me. I really appreciate it.
Thank you for the ability to have this discussion with you and visit with your audience. I appreciate it.
All right. See you soon, Rick.
Thank you.